Hello, good evening, everyone. I am Mansi Ganekar, working in the Investor Education Department of NISM. NISM is a capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in five broad areas: long and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is SIPs. Let rupee cost averaging work in your favor. So, for this, we have with us Kavita Menon. Kavita Menon is India's first SEBI registered fee only investment advisor and a seasoned financial planning professional with over 20 years of experience in wealth advisory. After building her career with leading private banking and wealth management institutions, she founded her independent fee based advisory practice in 2013 to provide unbiased, client centric financial advice to high net worth families. She serves on the board of AREA, Association of Registered Investment Advisors, and actively advocates for accessible, high quality financial advice in India. Kavita holds an MMS in finance and is a CFA and certified financial planner. Now I would request Kavita ma'am to begin with the session.
All right, so let's start. Uh, One of the most popular investment vehicles or methods of investing has been SIPs in the last decade. And essentially, what it does is it lets rupee cost averaging work in your favor. All right. How and what is SIPs and what is rupee cost averaging is going to be the basis of this presentation. But before that, I want to know from the viewers what has been your biggest concerns around mutual funds when you make a mutual fund investment. What is it that is your biggest concern? Let's take a poll quickly. If you could just run a poll for me, we'll just take a minute and take the participants' feedback here.
Yes, so 4% of the attendees have selected A option, then 10% of
Wow.
the attendees have selected B option, then 31% of the attendees have selected C option, whereas 54% of the attendees have selected D option.
So, difficulty in choosing funds is actually okay. There have been a lot of market research that has been done, and this our crowd of today's viewers seem to be very different from the rest of the market participants. Most market participants tend to think of loss of capital, market volatility, and market timing to be their biggest concerns. So let's just look into that. Okay, so unlike the audience here, investors fear three things the most: losing capital, wrong market timing, and volatility, market volatility. Okay, so the ups and downs of the market. And this problem is resolved by systematic investment plans. SIP removes the volatility or all the concerns that people have to the power of rupee cost averaging. So basically, it is a disciplined way of investing, a long-term approach to wealth creation. What is systematic investment plan? Basically, you invest a regularly you invest a fixed sum of money in mutual funds. Now that could be either monthly. There are also options to do it weekly, quarterly, etc. But mostly it is monthly and it is automated. It is automated as in it is an auto debit to your bank account and the investment happens by an instruction to your banker to debit your bank account and credit that of a mutual fund. The minimum investment is very small, as little as 500 rupees. All right. Now, what do you currently invest through SIPs? All of you who are in the audience, how many of you all invest in SIPs? I'd like to just take this poll, a quick poll. Yes, it's visible. So lovely.
Yes.
62% of you are already investing in SIPs regularly. This is fantastic. Do you know that in India today, 31,000 crores gets added to mutual funds via SIPs alone? And in a month, the last January has been a historical month. 71 lakh accounts have been added. New SIP accounts have been added. It's the all-time high in the market. So this is great to know that most of you are investing in some way or the other in SIPs. We'll close this. So what do SIPs essentially do is called rupee cost averaging. And that is the beauty of these SIPs. What essentially rupee cost averaging means, that because you're investing a fixed sum every month in the mutual fund, you're buying more units when the markets are down, when the prices are down. And when the markets go up, automatically you will be buying fewer units because the price will be high. Your invested value is nothing but the NAV multiplied by the number of units. So when the NAV goes up, your units are lower. And if the NAV comes down, your units are larger. So over a period of time, when you keep doing sums of regular sums of monies in via SIPs into funds, you will reduce your average cost per unit over time. So basically, you don't have to time the market. In fact, a volatile market is your good friend, because all the ups and downs actually leads to you getting a better average price of your investments. So volatility is actually good for the SIP investor. And you don't have to do market timing. And the risk of losing large chunks of capital is also minimized. I'll explain all this with an example. Let us assume that you are investing in a rising market. Okay, what will happen in a rising market? You will keep averaging higher and higher. All right, look at this example. Let's say I started an investment of 1,000 rupees in April 2025. And I continued doing this to July 2025. I'm investing 1,000 rupees every month. You can see the NAV is fluctuating, but it is on the higher trend. So from 27, it does dip to 22, but it goes higher again, 24.6. And then it lands at a higher level than my initial investment. So it starts at 27, ends at 28. This is a rising trend in the market. You will see that over a period of the rise in the market, my units that I'm buying are lower. But when the market comes down slightly, the number of units I will own increases. What happens because of this is I get an average, which is lesser than the peak of the market. It's not at the top, it's somewhere in between. And I have units which are at an average price, which is below than the top of the market. So in a rising market, you will average somewhere in between. All right. You may not get the top or the highest price. You may not get the lowest price. You will average somewhere in between. What happens when you're going in a falling market? Let's say you started, the market was at, the NAV of your fund is at 27 rupees, and it keeps falling down and down. You're in a lower trend market. What happens is your average price keeps coming down. Why? You'll keep buying more and more units at every correction. So from 27, when it falls at 21, you're buying a lot more units than you bought at 27. And similarly, when it comes down to 15 rupees in July, you will end up with almost double the number of units that you had than when the prices were at 27 at the peak. What this means is essentially your average price comes down dramatically from the peak of the market, and you get a lot more units. Just imagine when the next rally starts, you will be much better off. Let me explain this, how this will be better off. So say, supposing you made an investment of 4,000 at the peak at 27 rupees. You would have ended up with 148 units and a 44% loss in July. However, because you spread your investments in the 4-month period, you would have units. First of all, you would have more units, far more units than if you did a lump sum. And the average, the value of your investments would have fallen only by 23%, not 44%. So there is a downward protection because you have done averaging, rupee cost averaging. Okay, so this is what SIPs does for you in a longer term. Think long term, and then this becomes even more aggravated, becomes a larger chunk of savings for you during bad markets and more returns for you in top rising markets. If I give you a 12-month example, this is actual numbers of a 10,000 rupee SIP. If you did it for 12 months, your total invested value is 1,20,000 rupees. Now imagine there's a range of 48 to 57 rupees in the NAV of the fund. You would get via SIP, you would have got 2,267 units. But if you did a lump sum, you would have got much lesser units, almost 85 units less in a lump sum investment if you had invested at the beginning of the period. So this whole advantage of rupee cost averaging is getting more units and a better lower average price. So what is the key benefits of rupee cost averaging? Is it completely eliminates the need for market timing. You can invest at any time As long as there is volatility, you will have a better average than if you did a lump sum investment. It reduces impact of market volatility. So if the market, like we saw, when we did lump sum, we lost 44%. But when we did a SIP, even in the correction, we lost only 23%. So the downside risk gets reduced. It's not as severe as it is if it was a lump sum. Your average cost per unit comes down. But most importantly, SIPs inculcate what is called disciplined investment approach, because you are not having to take a decision every month to make the investment, because goes automatically from your bank account. It inculcates discipline, and that is the beauty of SIPs, that it happens on an automatic basis. Now, there are some SIP best practices that I want to share with you guys. SIPs are great. Rupee cost advantage is there. But how do you make the most out of it? How do you make the best out of it? So, a few best practices that you can use, and this will completely change your SIP from a plain vanilla returns. So, the first thing is you have to start early, even if your amounts are small. Okay. I'll give this with an example. So let's assume that there is Mr. A, whose age is 25 years, and there is Mr. B, whose age is 35 years. Now, A starts investing at the age of 25, and he is doing rupees 10,000 rupees every month. Mr. B starts at age 35, and he says, okay, I did not invest in the last 10 years, so let me double the amount that I'm investing. And he starts with a 20,000 SIP. So he's literally investing double of Mr. A's amount. However, when they both reach the age of 50, there's a big difference in the value of their investments. Huge difference. At a 15% rate of return, A has 2.8 crores in his kitty. And B, despite having invested more than A, will end up with only 1.2 crores. It's less than half of what A would have. What was that difference? That starting period that A got, he had a heads up of 10 years. A had a heads up of just 10 years. And that 10 years made all the difference to the investment value that they both had at the age of 50 years. So this is why time is important than timing. You have to give it time. The earlier you invest, the better you have your corpus has a better chance of becoming large sized. Okay. So this is one thing. The second best practice, you have to increase SIP with income. SIP is not a fill it, shut it, forget it kind of a thing. You don't do a SIP and then you just keep doing the same amount forever. Let's say when you are young, you would have started with 5,000 rupees. But after 10 years, your income would have substantially gone up. Then an SIP of 5,000 is not sufficient. You should, as per your income, as per the growth in your income, you should top up your SIPs. So that is your best practice number 2. I'll give you an example of how this works. Take example A and B again. Both of them are doing an SIP of 5,000 rupees. Okay, every month they're doing 5,000. Now A does 5,000 rupees for the next 25 years. He makes a 9% return on his investment. Okay, so what is the total number of years he's been investing? It's 25 years he's investing, and the total investment he's made is 15 lakhs. At the end of a 25-year period, 1,100 and so on and so forth. He keeps adding by 10%. By doing this, by the year 25, his installment has already ballooned to almost 50,000 rupees a month. Here, it will be 49,249 to be precise. His rate of return is the same as Mr. A's. His time frame is the same as Mr. A's. But his total investment is so much higher. He has invested 59 lakhs over his 25-year period. And because he has given more money into his investment, the final corpus that he gets is 1.4 crores. It is more than double that of Mr. A's. Okay, this is what happens when you top up your SIP. So it's a great practice that every year, or if it is not every year, then every 2 years or 3 years, as your income progresses, you keep increasing the amount of SIPs that you're doing. If you're a salaried person, then annual increments that you get can go into additional SIPs. It is actually the simplest way to ensure that you meet your longer term goals is to top up your SIPs, regularly topping up SIPs. So this is practice number 2. Before I get into best practice number 3, just a quick poll. Let's say the markets are falling freely, like now there is a war, and you are an SIP investor. What should you do with your investments in such scenarios? Can we have a quick poll? Can I see the results?
Yes, ma'am. I've shared you the results.
Superb, superb. So the largest chunk of your attendees have said that they will top up SIPs. This is such music to an advisor's ears. Making no changes is also fine. Absolutely fine. But if you can top up your SIPs when the markets are sliding down, there's such a big war-like scenario. If you think that the markets are going to be very weak for the next few months, then topping up SIPs are like the best action you can take. And making no changes is the next best action you can take. In fact, if you already have a plan, there's no need to make a change, right? So great to know this. We can just close this page. So the next best practice, the third best practice is to stay invested through market cycles, to not panic. And, like most of you have already said, you can top up the SIPs during bad market cycles, and that will absolutely improve your final returns. But I'll just show you a very fantastic chart, okay, of somebody who has started an investment SIP in 2007 Jan, which was just before the bubble, the financial crash, in fact, of 2008. Okay, assume he started a SIP at that point in time. This chart, if you look at it, gives you the returns, his SIP returns over a period of from 2007 all the way till 2021. His average returns on SIP has changed up and down several times. So you will see it has gone like, in 2008 at the peak, it would have gone to 70% SIP returns to 5% SIP return when the markets collapsed during the Lehman crisis. Then again 27% in March of 2009. And then it has been kind of very, very stagnant. As low, you can see there are returns you can see visible in 2017. It was as low as 7.4% also, SIPs. Okay. And then the crash came of 2020. His returns would have been 3.5%. It's delusional. I mean, you if you were a long-term investor, you would have been broken by these kind of returns. Okay. But just imagine one more year from then, you would have waited a year more and your returns would have again gone up to almost 12% CAGR. And believe me, this is only Sensex return. This is not a managed fund. If you were in a managed fund, chances are that your returns would have been even better than this. So the idea is that over the market cycles, all the ups and downs of the market cycles, you have to be disciplined enough to continue your investments. Okay. Uh, I'm an advisor, so I can tell you from experience what has happened. During 2008, during 2020, I have seen investors stop SIPs, withdraw money from the markets because of fear. Long-term investors. And the idea is let us take out money and then we'll wait when the correction comes and then we will re-enter. This in reality never happens. It can never be time, and it is impossible to tell that when the market correction will be over and when you will be able to come back. There is never a coming back. Okay, for some time you will feel happy that you made the right decision, but after that, the market has a mind of its own. We saw this during 2020 also. Anybody who panic sold during the COVID, early months of COVID crisis would have lost so much of returns because post 2020 March, the market went into a one-way rally. And we all know what happened after that. Okay. So the markets crashed all the way till about, I think the Nifty was almost at 7.5, if I'm not mistaken. And from there on, it just galloped away. And the markets are now well into 24,000. Nifty is about 24,000 now in a matter of 4-5 years. So very hard to time. It's very necessary that you have reasonable expectations and also long-term expectations from your SIPs. So this is a very good picture of what type of returns to expect. When you do financial planning, please do not overestimate SIP returns. I have seen people calculating 15% CAGR, 25% CAGR, and it's all uh, it is incorrect because these kind of returns are possible only in very short periods of time. But over longer periods of time, the more likely SIP returns are going to be in the range of 10 to 15%. So reasonable expectations and riding out market cycles is very important. One more poll. What is an ideal SIP duration for wealth creation? This is a question a lot of investors ask. What is ideal if you want to create wealth? How many years should you do an SIP? Can we have a quick poll? All the audience today is highly motivated and educated investors. I'm very proud of this. You are right. It is 10 years plus. So lovely. 10 years, 5 to 10 years, that's the ideal time frame for especially equity mutual fund SIPs. So we'll close this. This is great. This is great to know that almost 85% of you are doing long-term SIPs. Yeah. So if you really want to take the advantage of rupee cost averaging, you have to give it 5 to 10 years minimum. 10 years plus है तो बढ़िया है. It is great. That is how we look at it. Okay. So the fourth best practice here is to do the SIP for a really long time. Ideally, duration should be 5 years and upwards. Okay. Because in longer periods of time, you're allowing the investments to happen over market cycles, more volatile market cycles, and hence take the full advantage of rupee cost averaging. Okay. Uh, let me give you an example of how this will work and how when you just extend the time frame, the magic that happens because of compounding. So let's see this mathematically how it works. So this is a scenario. Please excuse me, I have taken a very high annualized return because I wanted to just give you the whole picture in the power of compounding over that much time. So I wanted to increase the return so it gives an impactful number for you to see. um, let's say you're investing regularly in mutual funds, okay, and you have invested for 15 years and you've done constantly, you've been very diligent, you've been doing 5,000 rupees every month. In 15 years you have totally invested 9 lakhs. You've got great returns, 18% CAGR. You're very lucky, you got 18%. Your final corpus will be 45.96 lakhs, but you just extend it by 5 years, just 5 more years. Just extend the SIP, keep adding to the SIP for another 5 years and at the same rate of return. Your investment value goes up only by 12, that's about 3 lakhs. You are just adding 3 more lakhs to your investment value. But the final corpus, the impact on final corpus is enormous, literally more than double. So from 45.96, you're looking at 1.17 crores just by extending the SIP by 5 years, right? So in SIPs, the concept of rupee cost averaging works even better as you extend the time frame because you're allowing the power of compounding to work in your favor here, right? So again, SIP is the best time frame, especially if you're looking at equities and long-term goals. Your best bet is to do it for as long as possible. So the longer the SIP, the better your returns will be. Now, the fifth best practice, all right? The fifth best practice is to link your SIPs to long-term goals, such as retirement, children's education, um, buying a home, maybe a second home, something that's in the pipeline. So things that you see much ahead in time as an expense, which will definitely come, and these are big milestone expenses. You can link SIPs to those milestone expenses, and that will ensure better. First of all, it will be more accurate. So this is not a SIP best practice, more it is a financial planning best practice. When you link your SIPs to these goals, you will have a more scientific approach to the SIP. Why? Because the amount that you will be investing will be more or less aligned towards that goal. It is not some random number that you feel, okay, today I can do 5,000 rupees, so let me just do 5,000 rupees. It won't be like that. It will be more like, to achieve this goal, I need to start doing a SIP of 6,500 rupees. And that is the amount I need to do for the next so many years so that I achieve my goal. I'll give you an example again. Assume today You need 30,000 rupees to run your life to maintain your standard of living. All right. Assume an inflation rate of 5%. In 21 years, that 30,000 is going to become 83,579. Let's round it to 84,000. That means to run your life, to have the same standard of living in 21 years, you will need 84,000 rupees. Okay. And assume that is the time of your retirement. So in 21 years, you have decided to retire. So that you get 84,000 rupees every month. How much money do you need as a kitty? So we have done a calculation. If it is invested at 7%, you need 1.4 crores. Okay. That is the minimum you need to have in your bank so that you can get 84,000 rupees monthly and live your life comfortably. Now, you know, in 21 years, you need 1.4 crores. What do I need to save today so that I can get to that 1.4 crores? If my returns, if my portfolio is earning me a 12% return, I need to save 12,583 rupees every month for the next 21 years so that I get to this 1.4 crores. If I'm able to improve my returns at 15%, I can invest little less. If I improve it even better at 18%, I can do with even less. But this 15 and 18% is khayali pulao. It is unlikely. I mean, too many things have to go right so that you get 15, 18%, which is why a lot of us planners do not use these higher returns when we're doing financial plans. We always tend to take returns at a conservative estimate. So you also calculated a conservative estimate. But at least whatever estimate you calculate, do know that you need to save 12,000 rupees every month in order to be able to retire in 21 years. Now, once you know that you have to save 12,000, that becomes your SIP amount, right? Now you have scientifically calculated what the SIP amount is because you have correlated it to a goal. In this case, we took retirement as an example, right? So that's the beauty of, connecting goal to SIP. And such goals, all such goals you can connect. You can even have short-term goals. Obviously, in that case, you'll not be investing in debt, in equities. You will mostly use debt instruments to get to that goal. Similarly, you would have medium-term, expenses that are coming up, milestones that are coming up. You will have a mix of debt and equity. But once you decide that mix, you will also be able to calculate what your amount of SIP should be. And that becomes scientific and that becomes more clearer in your head that this is what I need to do to get to my goal. Okay. So one of the best SIP practices is to link it to your long-term goals. Okay. Some common SIP myths that I will bust. SIPs have lock-ins? No, they don't. You can stop SIPs, you can pause SIPs, and you can redeem them also because they are all invested in mutual funds. And therefore, you can take out the money at any time that you want to. And they're all open-ended funds. Myth number 2, start only when the markets fall. We have already busted that. Any time is good because you have rupee cost averaging working in your favor. So SIPs do not require any kind of market timing. Myth number 3, SIPs tend to give lower returns than lump sum. This will be true in a rising market. If you were in a permanent bull market, this would have been true. SIPs would tend to give you lesser than the average lump sum investment. However, the fact is and reality is markets are never in a permanent bull market. They're always in a volatile, fluctuating. They come in waves, right? Returns come in waves, which is why SIPs always tend to give better risk adjusted returns. So adjusted for the volatility, you will see SIPs giving you better returns than lump sums. And the fourth myth, which we advisors get to hear very often, that SIP is an investment product. SIP is a mutual fund. SIP is not an investment product. It is a way of investing in a mutual fund, or it is a method of investing in a investment product. It is like a recurring deposit is to FDs, SIPs is to mutual funds. So this is just a method, a way of investing. It is not an investment by itself. When does rupee cost averaging shine? So I've established this before. You need volatile markets. The more volatile, the better your average returns are. You need to have a long investment horizon so that you get all the volatility in between and your averages get better. And of course, so that you can take advantage of all that volatility, you need to have a regular income also. So SIPs are best suited for investors who have regular income during volatile markets. Salaried people, professionals who have a regular source of income are best suited to do SIPs. What categories you should be doing them? Obviously, you want volatile categories. So you want equities only to be the asset class in which you're doing longer term SIPs. You can do equity funds, large cap, mid cap, be it whatever. But equity funds are best suited for uh, SIP investments. So again, I'll repeat the key takeaway of rupee cost averaging is SIPs by default automatically use rupee cost averaging. You buy more units when markets fall and fewer units when they are high. Okay, which because of which you reduce the average cost and volatility impact. SIPs do not require you to do market timing. And anyway, market timing is an impossible task. It's very hard to know when the market is going to be at the bottom and at the top. SIPs eliminates the need for such kind of predictions. You can be a disciplined investor and enjoy the benefits of better returns from the market. So this is it. This is thank you from me, and I'm open to take any questions from the participants.
Ma'am, there are a few questions in Q&A.
Ji,
I think you can address those questions.
I'm just trying to check the Q&A.
Yes,
Sahil, I'm not
it's
able to see the Q&A here.
ma'am, it's below, means right below between share screen and show captions option. Yes, Q&A. Is it visible?
Wait, let me stop sharing first. I'll just
Yes,
stop
you
sharing
can
so I
stop.
can see the... Yes, now I see the Q&A. Yeah.
Yes.
Wanting to time the market. So best of luck if anybody says they want to mark the time, time the markets, because the best fund managers have never been able to do it. And it's very, very hard to know when the market peaks and bottoms happen. And this is true of, I mean, most experienced fund managers will tell you that it is a useless pursuit to have to go and try and figure when the markets are up and down. So rather follow a process is what they will always advise you to do. Monthly SIP is better or daily? So there has been enough research that is done, and daily SIPs don't tend to give you any far better return than monthly SIPs. However, if you want to actually average out better, and especially in falling markets, weekly SIPs do tend to give you better averages than monthly SIPs. Daily का कोई बड़ा advantage नहीं है. There's no bigger advantage of doing daily SIPs, except if you really like a lot of transactions, so which I don't see the point of. Is it a good idea to spread the investments to different dates instead of putting all SIPs in a single date every month? Yes. Yes. So if you're doing 5 SIPs, I personally would like to do 5 SIPs on 5 different dates, because you're obviously, the whole idea is rupee cost averaging. So why would you put all your money again? If you have the option of diversifying your dates within a month, you should do it, because your cost average becomes better when you spread your investments. So yes, it is certainly better that you use different dates to do your SIPs. What is the effect of pausing SIPs for few months? Please compare non-stop SIPs and SIPs with a pause for a few months. Now, SIPs tend to, although they give you an average, what happens is markets performances come in big chunks. Okay, both corrections and rallies happen clubbed together in a few weeks or a few months. If you miss those few weeks and a few months, it's possible that you have lost some very good opportunities. It is possible. So pause SIPs is a great feature that is there in mutual funds, and you should do it, but you should do it only if it is absolutely an emergency. You just, there is a complete cash flow mismatch, you have a problem with your money, there is a money crunch or something like that. But stopping SIPs may lead to a big loss in opportunity if the markets go up during that time. But it's not like not a life changing kind of a thing. So if there is a problem, there is a money crunch, please pause your SIPs. That's all right, because you're going to continue you're not removing your investments, you're only stopping the SIPs. The rest of your money continues to participate in the market. How to select best SIP? So you don't select the best SIP. What you select is the best fund that is suitable for you. If you select the best fund that is suitable for you, you have a great asset allocation plan. Then you decide that in that particular fund, which is fitting into your overall asset allocation, which fund you should do an SIP in. So choose a fund which is appropriate for you. And SIP is merely a method of investing in that particular fund. There will be taxation too. On withdrawals of equity funds, there is taxation. On withdrawal of debt funds, also there is taxation. Can we add top up in the current SIP or start new one? No, you can top up. A lot of your platforms like NSE, MFU, Grow, etc., have a top up facility. You don't have to start a absolutely brand new fund. You can top up your existing SIP also. Ma'am, can you tell about FlexiCap SIP? See, again, FlexiCap SIP is not a product. FlexiCap is a product. And SIP is merely a way of investing in that FlexiCap. Okay? FlexiCap, because they have all equity, debt. Sorry, I'm so sorry. FlexiCaps have large, mid, small, all categories of market capitalization of companies. Where the fund manager takes a call as to where he should be primarily invested. It's flexi because the fund manager has a flexibility of choosing market capitalization. They tend to do well across market cycles. All right, then they take advantage of ups and downs in every asset class. So you choose flexi cap funds and then choose an SIP to go about it. Sorry. How can we identify the funds where we can get good returns in the long term, and that should be lower risk as well? Okay, this is outside the scope of an SIP query. But researching funds, there's a lot of material available online, and I don't think this is the right forum for me to address a question like that. So because it's not related to SIPs either, it's a whole session on itself, how to identify funds. How much percentage of an income should I invest in SIP percentage month? This is a very good question, Vitesh. How much should you invest in SIPs? Now, this should be a function of a plan. You should have a financial plan that this is the amount I need to save every month. First of all, you need to have a budget. The second thing is you need to have a goal. Once you do a goal planning, you will know exactly how much you need to save. And then you decide what percentage of the income should I invest in SIP. So your financial plan will give you a idea of how much you need to save and how much should go in SIPs. Okay. Don't do the other way. Don't start investing in SIP just like that, because see, every one of us has needs in our homes, our families. We have money requirements coming in the short term. Now, if you just put a large chunk of your savings into SIPs, you also need money to live. Now, you need to have a standard of living today. Everything cannot be saved. So having a right balance, having a budget in mind, having your goal planning done should dictate how much you invest in SIP. When market fall, is lump sum investment good idea? See, again, it depends on your risk profile. I'm a big believer that when there is a market fall, you should have some money going into the equity markets. But again, it's a function of your risk-taking ability, because sometimes markets can correct even well beyond what we thought is a fall. It can fall beyond that fall also. So you should be okay to take short-term losses when market corrections happen. Again, your risk-taking ability is very important. So that should be a function of how much to invest as a lump sum is again a function of your risk profile. In multiple flexi-cap funds, of course, you can invest in multiple flexi-cap funds. I'm a retired person and have been investing in SIP during my working years of 10 years. I've stopped SIP and have not withdrawn the amount. But I realize the returns are getting lesser now in downturn times. So, Mr. Ramachandran, the returns are not actually coming down. It is that the last 2 years, you have seen the markets have been pretty bad. They have been more or less flat to negative. And what happens is, in such markets, your overall corpus either doesn't grow or stagnates or it comes down. Now, when that happens, your net IRR, because you've invested for such a long time, your IRR does tend to come down. So you will see your returns per se, you will see them coming down. But investments is a game of playing the cycles. So while you're not withdrawn the amount, and since you are retired, I would suggest that when the market rallies, now whenever that rally happens, do make it a practice to take out some profits and put it into a safe asset. Because it'll help you. You are not making, losses, but in profit times, at least you're booking some profit and keeping it safe, and that you can use for your retirement expenses. So it may be a good practice to create some framework in which you withdraw money at every rally in the market. So you could decide that on a 20% rally in the market, I will take out some amount of money from the portfolio. But that's a good practice to have. How many funds should be given? Okay. How many funds should be given? I have no answer to that. Again, depends on the client's portfolio. Generally, we design portfolios which are between 5 to 7 funds, and that's it. How is SWP different from SIP? This is great. This is a good question. SWP is a systematic withdrawal plan. And SIP is a systematic investment plan. They are both opposite of each other. So SIP is used to accumulate funds and SWP is used to withdraw funds from the portfolio. Typically, during retirement, now you have a corpus and you want the corpus to pay you something. You can do a systematic withdrawal plan from the portfolio. So every month, a fixed amount of money will get debited from your portfolio and get credited to your bank account. The exact opposite of SIP. SIP, what happens? The money is debited from your bank and credited to a mutual fund. In SWP, it gets debited from the fund and gets credited to your bank. The exact opposite. Okay. SIPs is used for accumulation. SWP is used for withdrawals. How many times can you skip an SIP? Most funds allow you to pause an SIP for 3 to 6 months. If you skip SIPs without pausing them, I mean, you don't have the money in the bank, it's possible your banker will charge you a fee. So, just be careful that you don't let your SIPs bounce. What about exit load? Is it higher in case of daily SIP? No, it is not higher in the case of weekly or monthly SIPs. The exit load is the same for weekly SIPs, monthly SIPs, or daily SIPs. It will be the same as it is for the fund itself. Okay, the SIPs themselves don't have a different exit load. What is the difference between rupee cost averaging and compounding? How it works in SIP? Rupee cost averaging is basically having higher units at lower cost. Compounding is the end product of SIPs over a period of time. That means it grows over a period of time, and that benefit of time is the compounding effect that you get. Rupee cost averaging is merely the very fact of getting higher units at lower averages. Will power of compounding help SIPs grow? SIP will grow if you add money to the investment. Otherwise, there is no way for SIPs to grow. The investment in which you're doing SIPs will grow with the power of compounding. Okay, if you provided you give it time and provided it's a good investment. What is your opinion for the next 2 years for SIP? Domestic or international like Motilal Nasdaq fund or something domestic like Mere Asset Services fund? So I'm a believer of asset allocation. I don't believe I have the skill to time markets. So my investors, we do SIPs in a basket of international, Indian, commodities, etc. So we do continuous investments in a basket of assets. We don't like to time. So if you ask me what is the opinion for the next 2 years and where you should be doing the SIP, my answer is please follow your asset allocation. That should be your Northern Star and you follow that. Okay. Sahil, I think I've taken all the questions.
Yes, ma'am, you have answered all of the questions. So, as ma'am, I will request you to touch upon the key takeaways or the session highlights as we have few more minutes to go. So you can address that.
Yeah,
Like
so
the
the key
important.
takeaways, I think I had a slide on that also. The key takeaway is SIPs basically allow you to take advantage of rupee cost averaging. The best way to take advantage of rupee cost averaging is to do it over a period of time, a long period of time, to start as early as you possibly can. All right. To link your SIPs to a particular goal makes the investment a better, more accurate product or accurate investment for your goals. And finally, of course, it gives you discipline. If you are doing SIPs, the best part is that there is a disciplined approach to investing, because SIPs are a automatic process. They debit your bank, they credit your mutual funds without you having to do any transactional hodgepodge at all. You don't have to be interfering in it at all. It's just once you set it up, it starts. It's a auto system that takes care of itself. So all that it needs is reviewing once in a year, perhaps, or 2 years. Take a review, see where you're going, where your performance is. But that's about it. So discipline and long term is the key that helps SIPs work in your favor. So anything else, Sahil? The questions are answered, I believe. So
Yes, ma'am. I also can't see any other questions. So there is one question, ma'am, at last,
yeah.
that from Maitri Shah.
So Maitri, there is nothing called SIP companies. I will again say SIP is simply a method of investing in mutual funds. So your question should be, help me select mutual funds, not select SIPs. SIP is just the way in which you can invest. It's like saying how a recurring deposit is for a bank FD. What it does, little, you start putting, and it becomes one big amount at the end of the period, right? That's what recurring deposit is like. SIP is same thing for mutual funds. Systematically, you keep buying little, till it becomes a large quantity with the power of compounding working in your favor. So don't say SIP companies, say that you want to select mutual funds, good quality mutual funds. And unfortunately, it's beyond my scope to help you select in mutual fund investments today. But I would strongly recommend that there's a lot of research. See, NISM is also doing a lot of courses on investments. I would suggest you go through those courses, see how to select mutual funds, and then start your SIPs in those funds. There are a few more questions, Sahil, but they're not related to SIP, so I have not taken it. Like somebody's asked me about dividend paying companies, etc.
Mhm.
I don't think that's in the scope of this session, so I've just ignored it.
Yes. Also, ma'am, many of the attendees is appreciating you for the session, and I can see
Thank you.
that many of the attendees saying thank you to you for the session.